Okay, just one more here on common size income statements. And we've got two companies here that we're going to compare. So we're going to turn these income statements into common size income statements. Again, net sales revenue will be the base. So we do everything as a percent of net sales revenue. So this is obviously 100. Then we take 7917 divided by 1300, and we get 60.9%. 4342 divided by 1300 gives us 33.4%. And then 741 divided by 1300 is 5.7%. We do the same thing for Alto. Obviously, this is 100% because that's the base. Then we take 15,730 divided by 22,000 times 100, and we get 71.5%. And then we have 5170 divided by 2200, and we get 23.5%. And 1100 divided by 22,000, sorry, I think I said 2200 before, 22,000 is 5.0%. So who earns the higher net income? Alto has the higher net income, but which one has a higher percentage? And that is Connor, because they get to keep 5.7% of every dollar they earn, whereas Alto gets 5%. And the difference here is in the cost of goods sold. You can see that Connor has a lower cost of goods sold as a percent of revenue than Alto does. And so because they're able to, I mean, they have a higher other expense, but that's smaller. So since that cost of goods sold is their primary expense, having a lower cost of goods sold as a percentage of the revenue is why they're able to yield a higher income. All right, so that takes us to ratio analysis. And again, you've done lots of ratios already. So this is, some of this will be reviewed, some of these will be new. There's a lot of them. We break them into 5 categories. And so I have kind of a section for the formulas and the ratios in each one of these categories. So we look at, and different companies will look at different things. A potential investor is going to be looking at different ratios, say, than a bank looking to loan them money or something like that. So different people are going to be looking at different ratios. So we've got the ability to pay current liabilities, the ability to manage their inventory and their receivables, the ability to pay the long-term debt, the profitability, and then evaluating the stock as a potential investment. So the first section we want to look at here is the debt ratios for the current liabilities. So what these really measure are the company's ability to pay their current liabilities, okay, to make the payments on the current liabilities. So the first one we see is working capital, which is just current assets minus current liabilities. That's the ability to meet your short-term debt obligations with your current assets. So do you have enough cash or close to cash around to pay your current bills? So that's pretty much all that one is. We've got the cash ratio, which is cash plus cash equivalents. So in most of the cases for us, that's just plain old cash divided by total current liabilities. Cash equivalents are things that are so close to cash you could convert them to cash so easily that we call them cash equivalents. Most of the time I'm going to tell you that they're not like this number is good and this number is bad, because with almost all of these ratios it has to be compared to something to mean something, but every once in a while they give you a thing. So this one should be less than 0. This is a very conservative measure, it's a very strict kind of a thing there. The acid test, or the quick ratio, it's also called the quick test. Those are all different names that mean the same thing. It's a very common one. You take the cash plus the cash equivalents plus any short-term investments they have. Again, those are things that could be turned into cash fairly quickly, plus the net current receivables. Net current receivables. And when we say current receivables, the net, remember back when we did receivables and we had the receivables minus the bad debt or the stuff you didn't expect to collect, so that kind of stuff. So the net number there, you take all those things together. So all of these are, it's really, if you take these, it's all of your current assets except inventory, and prepaid. You're not counting inventory or prepaid assets, but you pretty much have all your other current assets in here. And then you divide that by total current liabilities. Okay, that's your acid test. In a lot of the ones that we're looking at, that's net current. Sorry, current. In a lot of the ones we're looking at, this might just be cash and current receivables. Might be the only two things you have in there. But if you have short-term investments, you would include that in there as well. So that's the formula for that one. So it looks like there's a lot in there, but a lot of times you won't have all of those things in there. And then the broadest measure, the thing that is the least strict, we'll say, of these, is the current ratio, which is current assets divided by current liabilities. It's a very common one. I'm sure we looked at this back in Accounting 1. This is usually, according to the book, around 1.5, but it can vary a lot depending on the industry, but varies. So, stop that. So those are the three, four if you include working capital. So those are the four formulas that we have for this one. Cash, that's a big long one there, and current assets minus current, or divided by current liabilities. Okay, so for almost all the problems I'm going to do in this book, in this chapter, we have two income statements, and they'll show up in your problems. You might want to kind of have these handy. So I'm going to try not to flip back and forth too much because I'm afraid I'll make everybody motion sick. When I do this one in person, I'll have this up on one projector and the problem up on the other so we don't have to keep flipping back and forth. And then they tell you this information down here that you'll also need. So this is the data that we're going to use for all of the problems for the rest of this video. So the first one asks us to compute the current ratio at May 2018 and May 2017. And so the current ratio is total assets divided by, total current assets, that's important, divided by total current liabilities. And they want this for 2018 and 2017. So, go back here. So what we're looking at is total current assets here for 2018 and 2017, and total current liabilities, which is right here, for 2017 and 2018. So for 2018, I'm going to take the total current assets of 52.8 divided by the total current liabilities of 2,800. And then for 2017, I'm going to take 2520 divided by 13.2. Oops. So we've got 52,800 minus 28,000, divided by 28,000 equals 1.89. And then we've got 25,2 divided by 13,200, which gives us 1.91. So with this ratio, they're pretty much holding steady here. It's basically those are both 1.9, so that really hasn't changed that much. That's a very kind of common measure, and again, somebody looking to loan them money would be interested in that because it measures your ability to pay your current liabilities with your current assets. So 1.9 means they have almost twice as many current assets as they do current liabilities. That's basically what that's telling you. Okay, inventory ratios. So we've got quite a few of these. Inventory turnover ratio, we did look at that. Most of these we have looked at in accounting 1, but it's probably been a while. So, so inventory turnover is cost of goods sold divided by average merchandise inventory. And remember with these ratios, anytime you see average, they want the beginning number plus the ending number divided by 2. So if we're doing this for a year, they want the merchandise inventory at the beginning of the year plus the merchandise inventory at the end of the year divided by 2 to get your average merchandise inventory. So this tells you the number of times per year that the company sells its average inventory level. So this is how I picture it. If you pretend like they had their little inventory room and they don't reorder until they sell everything in the inventory room, it's the number of times that they sold everything and restocked and sold everything and restocked and sold everything and restocked, like that. That's kind of what it is. So higher is better. That means that you are selling it quickly and restocking. That is reflected, another way to look at this exact same number is the days sales in inventory, which is 365 divided by that inventory turnover that you just calculated, okay? So once you calculate inventory turnover, you can calculate days sales in inventory. That is the average number of days that inventory is held. It's the average number of days that something is sitting in our inventory before we sell it. Lower is better. We want it here for as little amount of time as possible. So inventory, you had to pay for it, right? You pay cash or whatever, and then you turn around and sell it, so you don't get paid back until you resell it. The faster you get paid back for that, the more you can do with that money. So that's why companies like Walmart, where inventory is huge, spend millions of dollars on inventory systems because they can make even more millions of dollars save by turning that inventory over. So these two are a reflection of each other. It's going to vary a lot, like a jewelry store or a mattress store or something like that is going to have a low turnover, so they would not compare themselves to like a grocery store, but so they would compare themselves to their main competitors, whereas something like a grocery store is going to have a very high turnover. You don't want those bananas sitting there for a long time because you're not going to sell them. And somebody like, let's say Lowe's, is probably going to have some things with a really high turnover, and then other things like the appliances with a really low turnover. So they might have to break theirs into groups to see kind of what's going on there. Okay, the next thing is gross profit percentage. And so this is gross profit divided by net sales revenue, which we would have seen on that vertical analysis, right? Because it's everything as a percent of net sales revenue. It's the ability to earn a profit on your inventory. It's also kind of tells you your gross margin. So how much profit are you generating on your revenue? How much do you get to keep of it? To improve this, if this is too low or if this is going down, you got two things to do. You can decrease your cost of goods sold, or you could increase your revenue or your selling price. Of course, if you increase your selling price, you'll sell less, right? So lots of things to consider there, but that's basically the two factors involved with that one. So if you're in a very competitive industry, you might not be able to increase your selling price. And so the only way for you to increase your gross profit percentage is to lower your cost of goods sold, which can often be done by managing your inventory more efficiently. So that's why this is in here. So if you can reduce that days sales and inventory, you might be able to increase your cost of goods or decrease your cost of goods sold. Then we look at receivables. So that should be here, inventory and receivable ratios. Accounts receivable turnover ratio. So this is your net credit sales. So the amount of sales you do on account divided by your average net accounts receivable. So again, average would be the beginning plus the end divided by 2. So this is the number of times per year that you collect your average accounts receivable. That you collect the average amount that you have in receivables. If it's too high, that means your credit is probably too tight. So remember your credit terms, how many days you give people, and the discounts and all those kinds of things, and the 210 net 30, all that kind of good stuff. So if this number is too high, that probably means your credit terms are too tight. You're not giving credit to enough people. Again, this is primarily your business-to-business sales, which means you're going to have lost sales. If somebody else is offering better credit terms, they might get the sale instead of you. If it's too low, then you might have a greater chance of not collecting your stuff too. So if it's too low, you're probably not getting paid. So anyway, so that's kind of what we're looking at there. And then the last one we have is days sales in receivables, which again, just like the inventory is a reflection. So I take 365 divided by the accounts receivable turnover ratio. Faster is better. The faster I collect it, the more time I have, the faster I get my cash back. It's better for my overall cash flow, and I have that money to do other things with. So those, let's see here, 1, 2, 3. Those are our 5 ratios related to inventory and receivables. So now in this problem, we are going to compute the inventory turnover, day sales, and gross profit. And then we're going to do the day sales and receivables. And what does this tell us? So we basically, it's 2 problems, but we're going to do all 5 of those. So inventory turnover is cost of goods sold divided by average merchandise inventory. So if we go back to this original problem, and I'm not going to do this for all of them, but at least for now we'll do. So what I'm looking for is my cost of goods sold, which is here on my income statement, divided by average merchandise inventory, which means I'm going to average these 2 things together right here. So my cost of goods sold was 28,400 divided by, I'm going to take my 2 inventory numbers and average them together, divided by 2, so I get an average inventory. So I get 28,400 divided by 77.5 is the average, so I get 3.66 is the number of times a year I turn over my inventory. So days sales in inventory is 365 divided by 3.66, so that's 100 days. So the average inventory item is here for 100 days. Is that good or bad? I have no idea. They'd have to compare that to another time frame, or also their competitors, that kind of stuff. And then the gross profit percent. Gross profit percent is gross profit divided by net sales revenue. And did they give us gross profit on that one? I think they did not, but we can figure it out. So net sales minus cost of goods sold. So gross profit would be 12.2. 40,600 minus 28.4, and so I would get 12.2. So that would be $12,200 divided by the net sales revenue was 40,600. So that's 0.3, which is 30%. And then I've got two asked me for accounts receivable turnover, which is net credit sales divided by average net accounts receivable. So our net credit sales, they, I think, do all of their sales on credit. It told us in there. So that's just their net sales. So that's 40,600. And then the two accounts receivables that I got off the balance sheet would be 5,200 plus 7,500, and then average those two together to get 63.5. So I get 6.394 times, oops. And then if I want days sales in receivables, I just take 365 divided by the accounts receivable turnover that I just figured. So 365 divided by 6.394 equals 57 days is the average amount of time it takes somebody to pay their accounts receivable. You'd want to compare that to your credit terms. So if I offer 210 net 30 and it's taking people on average 57 days to pay, that's not good. But if I have 60 day or 70 day or something like that credit terms, I probably have 60 day. And so most people are taking the whole, or really close to it, which means maybe I'm not offering a discount, or my discount's not that good that people aren't really paying it. So but if I have 90-day terms or something like that, then that means they're taking it. So you really need to compare that to your credit terms to see what that's telling you. Okay, long-term debt ratios, we've got 3. And so this measures the ability of a company to make payments on their long-term debt. So, your short-term debt is largely your accounts payable. So a firm, looking to extend your credit would look at that. This would be more like a bank or somebody looking to buy bonds or something like that would be looking at these. So your debt ratio, total liabilities, I'm pretty sure we've looked at this one before, divided by total assets. It's a very common one. What this shows you is the proportion of your assets that are financed through debt as opposed to equity or something, that are financed through debt. So the higher this number is, the riskier this company is, the more risk they have assumed. On average, it's somewhere between 57 and 67%. You don't want it too high, right? Because that's risky, but you also don't want it too low. If this company has no debt at all, it probably means they are stagnating, okay? They're not updating their assets. They're not investing in technology. If they have no debt at all, that means they are still doing stuff the way they were doing it, 30, 40, 50 years ago, which is generally not that good, unless they're just generating so much cash that they don't have to do any debt, which is also unusual. So too low is also kind of a red flag that you would want to look at. I mean, maybe there's a good reason, but in general, that could be a red flag. So the debt to equity ratio is total liabilities divided by total equity. So this is it measures financial leverage, and we talked a little bit about that in some of the other ones. So if this number is greater than 1, that means they are financing their assets with more debt than equity. So they're more likely to borrow or issue bonds than they are to issue stock. If you're a stockholder, that's probably what you want. If it is less than 1, then they are financing with more equity than debt, which, if you are a lender, is probably more what you'd like to see. So that's what that one tells you. And if it's 1, then that's, they're doing about the same there. And then the last one here is the times interest earned ratio, which is their earnings before interest and taxes divided by their interest expense. So earnings before interest and taxes is net income, add back in the tax they paid, add back in their interest expense. Okay, so what we really want to do is look at their earnings. So if you finance through debt, you have to pay interest. If you finance through equity, you do not. So we're kind of trying to take out the interest to equalize that. So we're not looking at so what this measures is really your ability to pay your interest expense. Again, somebody looking to lend you money or buy your bonds would want to look at this one. Okay, so I take my earnings before that and then divide it by the interest expense. So then it kind of, the higher the number here, the easier it is for you to make your payments. Easier to pay. So if I see somebody with a nice high times interest earned ratio, I know they're not going to have any problems making the interest payments on their bonds or on their loans. So there's 1, 2, 3, like that. All right. And I think I just have one problem here. And then that takes us to the profitability ratios. Okay, so measuring ability to pay liabilities, compute the debt ratio and the debt to equity ratio for our company. And what does this mean? So the debt ratio is total liabilities divided by total assets. And then the debt to equity ratio is total liabilities divided by total equity. And so all of these we would get off of our income or our balance sheet right here. And so I'm looking at total liabilities, I'm looking at total assets, and I'm looking at total equity here. So these are the three numbers that I'm using for 2018. So total liabilities were 41.9. Total assets were 82.8. So I get 0.506, which is 50.6%. That's how much of their assets are financed with liabilities. And then here I get 41.9 divided by 4,900 for the equity, and I get 1.02. So they're financing about equally, which is why they get that nice 50% ratio there. So their ability to pay their their assets is pretty strong. They've got a fairly low debt ratio and a debt to equity that's nice and even. So no red flags there for that one.